What if I told you that every dollar in your pocket, every number in your bank account, is actually someone else's debt? That's not a metaphor, it's how our entire financial system is designed. If you hold money, it's because somewhere, someone owes money. A mortgage, a government bond, a corporate loan. The global economy is built on this strange paradox. Money isn't wealth, it's an IOU. And yet, we rarely stop to ask the obvious question. Why? Why does money have to mean debt? What if it didn't? What if money could exist without someone else being chained to it? History shows us it's possible. But to see that clearly, we first need to understand how the current system actually works. Because most people have no idea. Let's start with banks. We're taught that banks are like middlemen, taking deposits from savers and lending that same money out to borrowers. Simple, right? Except that's not what happens. In reality, banks create new money when they issue loans. If you borrow $100,000 for a house, the bank doesn't take it from another customer's account. It simply types those numbers into existence. Your mortgage creates brand new money. That $100,000 wasn't in the system yesterday, but today it is with one crucial condition. You owe it back, wheat interest. Multiply that across millions of loans, and you see that most of the money in circulation was born as debt. Governments do it too. When a government spends more than it collects in taxes, it borrows by issuing bonds promises to repay in the future with interest. When investors or banks buy those bonds, new money enters the economy. But again, it's money tied to debt and the obligation that future taxpayers must honor. And here's the kicker. The system only survives if debt keeps growing. If people stop borrowing, the money supply shrinks. If governments stop issuing bonds, the economy dries up. Like a shark that has to keep swimming to stay alive. Our financial system has to keep expanding debt, or it collapses. That's why central banks panic when lending slows, why interest rates are cut to encourage borrowing, and why inflation is tolerated. The system is addicted to debt-fueled growth. This design has consequences. It means inflation is built in, as more debt creates more money, eroding the value of your savings. It widens inequality, as those who lend get richer on interest, while those who borrow pay for it. And it means true financial freedom is nearly impossible. You can pay off your personal debts, but you can't escape the fact that the very money you hold is someone else's liability. But it wasn't always this way. Debt money is a design choice, not a law of nature. Take ancient Mesopotamia, over 4,000 years ago, when farmers' debts to temples became overwhelming. Kings issued debt jubileous blanket cancellations to wipe the slate clean. It wasn't charity, it was survival. They understood that endless debt would destroy society. Or look at medieval England, which for over 500 years used tally stick-split pieces of wood with niches marking obligations. They circulated as a trusted medium of exchange, a record of what was owed, but without the trap of compounding interest. A kingdom ran on sticks of wood, and it worked longer than many modern banking systems have lasted. Even Abraham Lincoln experimented with an alternative. During the Civil War, he introduced the greenback paper money issued directly by the U.S. Treasury, with no debt attached. They were used to pay soldiers and fund the war effort. But after the war, bankers, who profit from interest on debt, lobbied to shut them down. These stories prove a simple but powerful point. Money is a tool, and debt is only one of its possible designs. And if the past shows us it can be different, the present offers living examples. In Switzerland, the Wehr Bank, created during the Great Depression, allows businesses to trade using a mutual credit system, not debt-based currency. Its credit is trust, not as a weapon. Local currencies like the Bristol pound keep wealth circulating within a community. And then there's Bitcoin, created as a direct challenge to central banks' money. That's finite, independent, and not born from debt. Each of these has flaws, but they all prove that alternatives are possible. Even governments are now exploring central bank digital currencies, or CBDCs. This could allow central banks to issue money directly to citizens, bypassing the private banks that create money through debt. But this comes with a huge risk. While it could weaken the grip of debt money, it could also lead to unprecedented state control over every transaction. So why does this matter today? Because the cracks in our debt-based system are widening. Global debt is at record highs. Governments borrow endlessly, Households are drowning in loans, and inflation is eating away at wages. And every time the system stumbles, the solution is always the same. More debt. This isn't just abstract economics, it's personal. Your mortgage, your taxes, your paycheck day are all products of a system that functions only if you and millions like you stay in debt. But the hopeful truth is, it doesn't have to be this way. Debt money is not a law of nature, it is a design, and designs can be changed. Real financial education isn't just about balancing a checkbook. It's about asking the hard questions. What if the system we rely on breaks? If inflation erodes my paper wealth? What assets of real value do I hold? Money doesn't have to mean debt. It could mean trust. It could mean resources. It could mean freedom. But only if we dare to imagine it, and then demand it. If this gave you a new perspective, hit that subscribe button. History has the answers, and I'll show you where to look.